Hello, my name is Elisha and welcome back to the channel. So today we are diving into the iconic concept of Mr. Market. This is a brilliant metaphor introduced by Benjamin Graham in one of his iconic books called The Intelligent Investor. Grab a coffee, let's explore how Mr. Market can change the way you invest. Imagine you had a business partner named Mr. Market. Mr. Market knocks on your door every day. You go out there, you say, "Hi, Mr. Market." Mr. Market says, "I'm doing just fine." One day he's very happy, he's on top of the world, and he's selling shares for exorbitant prices. So a share that would cost $100 would be going for 250 or 300. And then the other days he's not so happy. He's a bit under the weather. He comes, knocks on your door and he says, that share I had the other day for $300? Well, that same share is going for 100 today. So that's Mr. Market. He's very changeable and he's making pitches to you. So Benjamin Graham introduced Mr. Market in his classic The Intelligent Investor, and if you haven't read it, I encourage you to go and read it. It will really help you to make better investment decisions. So Mr. Market, you can either buy or you can say, you know what, I'm gonna pass today. This actually personifies the daily mood swings of the stock market. So Benjamin Graham says the market is there to serve you, not vice versa. You should use it to your advantage. Don't always take what's thrown to you by the market, because some pitches, maybe they're too expensive or something has happened and they're just not what you want at that particular time. Here's why the Mr. Market concept is so powerful. Number one, emotions drive price and not value. So Mr. Market usually reflects what people are feeling at that particular moment. If people are scared about tariffs, prices are going to be lower because people are operating on fear. If there is war in Iran, for example, people are going to be operating on fear and not the fundamentals that govern the companies that you're investing in. So value remains constant, but people's moods between fear and greed change often. And as Graham said, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. Number two, you are in control. Mr. Market will be bouncing all over the place, but you're not obligated to act. So as Warren Buffett says, you get balls thrown at you all the time, but that one that you know you're going to hit a home run, that's the one you go for. So Mr. Market is making those pitches to you every day, but what you do is choose the right pitch, the one that you beat out right out of the park. That's the one you go for. So if Mr. Market is irrational today, let him be. Wait until he offers you a price that makes sense. So number three, opportunity arises from volatility. Investors don't shy away from volatility. They actually open their eyes and start to get interested when prices are going down. As Warren Buffett says, be greedy when others are fearful, and be fearful when others are greedy. So when prices go down, people start to be fearful. And this is when you have to now start to look around and shop for bargain. So I'm going to go into real world examples to show you how this works. So if we look at Warren Buffett in 2008, there was a financial crisis and everyone was rushing to sell. But Warren Buffett was actually bargain hunting for stocks.
How much for Goldman Sachs?
This is the time that he bought companies like Goldman Sachs and General Electric, not because it predicted the market's bottom, but because the prices were far below intrinsic value. In contrast, during the dot-com bubble, Mr. Market was euphoric. He was selling a lot of tech stocks at prices that are way above market prices. So as a result, it was a painful crash. Mr. Market misled everyone who was buying into those tech stocks, and they followed. I want to give you two examples from the dot-com bubble so that you can understand where I'm coming from about this Mr. Marketing and how it can help you to make better investments. So Cisco Systems, for example. Cisco peaked near $80 a share in March 2000, then lost about 90% of its value by late 2002. So while the stock has rebounded and even hit a 25-year high of around $66, it still remains under the year 2000 all-time high of $80 a share. Then there's also Qualcomm. I don't know how you pronounce that. Qualcomm or Qualcomm, whatever. It lost around 86 of its value, and it has taken 2 decades to actually approach that level. So this is just to educate you and to make you aware of how sometimes the market drives prices to exorbitant euphoric levels where people have altogether lost sense. So how do we use this insight? How do we apply the Mr. Market lesson? And this is a chapter in The Value Investor that Warren Buffett says is one of his favorite chapters, including the margin of safety. So how do we apply this in our day-to-day investing? So focus on fundamentals, not on the daily price movements, and study the business. Stay rational. Don't buy in euphoria or sell in panic. Be patient. The right opportunity will come. And as Charlie Munger says, the big money is not in the buying or selling, but in the waiting. So Mr. Market is your manic depressive business partner, but with discipline and a long-term mindset, you can turn his mood swings into your advantage. So next time the market drops, remember that it's just Mr. Market knocking. Don't let Mr. Market push you around. You decide whether you want to go in. You decide whether you want to buy. Don't let Mr. Market come to you with something that's 2 or 3 times above the intrinsic value. You decide if you want to make that purchase. Don't let Mr. Market push you around. If you enjoyed this, drop a like, share the video, and hit that subscribe bell. It doesn't cost you a thing. Let me know in the comments what your favorite lesson is from Benjamin Graham. And until next time, invest with discipline and stay the course. Cheers.